Hello, I'm Chris Didier of the Baird Generational Wealth Group, and welcome to our webinar on transition planning for business owners. So why are we doing this? Well, if you followed anything, you know that we pay a lot of attention to the cycle in terms of how we position our clients for what's coming next. And one of the resources we use for that, I've been a Vistage member for 20 years now. Brian Bolio and ITR have been a big speaker at a lot of Vistage events. We've hosted them on several occasions. And if you follow them, you know that they've been talking about an event that's going to happen out in the 2030s. And so we've been getting a lot of calls from business owners that have been saying to us, hey, I'm paying attention to what Brian and ITR are saying about the 2030s. And I think I need to position myself to sell my business. So what should I do? And so we got those calls and we work with some people. We do what we call a roadmap, and we'll talk a little bit more about the roadmap. There's resources internal at Baird that I'll refer to try to help them. But it made me think that there are a lot of others out there that are thinking about the same sort of thing. So as part of Baird, we have a lot of resources that we can draw on. I'm really proud of that. When I started at Baird, we had less than 500 people. Today, over 5,400 associates and footprint that's globally. A lot of recent accomplishments as an owner I'm extremely proud of. But what I'm most proud of is the fact that we've been on Fortune's Best Place to Work for the last 18 years. And what that means is we have a lot of great people internally that we can rely on as resources. One of the things, in fact, that I don't even mention on here is we have a macro firm by the name of Strategis, which is an independent, wholly owned subsidiary of Baird, and they rank number one. Number one is a macro research firm by Wall Street Institutional Investors. So that's pretty cool and a resource that we can rely on. One of the things that we do as part of our group, we do a lot of different things. So we're doing things from data aggregation to sounding board. What we're going to be talking about today is financial strategy and sounding board. And so one of the resources that I often rely on is Jason Spitz, who's part of Baird's Business Owners Solution Group. And I'll go to Jason with different questions that people will prompt me on, saying, well, what's the M&A environment like for the coffee industry? Or what's the M&A environment like for a car wash business? I have a chain of car washes. Or what's the M&A landscape looking like for my manufacturing business? And I'll go to Jason and he'll give me some insights on that. So I thought it would be great to have Jason here to talk about transition planning. We're going to cover the transition considerations, transition process, valuation drivers, post-sale, current market thoughts, and we'll wrap it up with some concluding thoughts and next steps. So Jason, just so you know, before coming to Baird, I spent 8 years in the NFL. Came to Hilliard Lyons as an investment banker in Louisville. Is in our Louisville office. Baird acquired Hilliard Lyons several years ago, and so he's part of our team. So, Jason, welcome to you. Thank you for being here. And so, I guess before we dive into all this, tell us about Baird's Business Owner Solution Group and what you do there.
Yeah, so Baird's Business Owner Solutions Group is a lower middle market investment bank tucked inside of our global investment bank, but that's really for compliance reasons. We're really a service arm for our private wealth network. So essentially, we help Baird's business owner clients with their investment banking needs. And we really bucket that into three services. The first we call transition planning. So we help business owners figure out what to do with their business. More often than not, most lower middle market business owners don't have a complete understanding of all the exit options available to them. So we act as a sounding board to let them articulate what it is they want to accomplish. And we work together to develop a game plan to help them meet those objectives. Second, and probably the most important for a business owner, we help them figure out what it's worth. Business owners don't have access to the databases that we do, so they make unlike comparisons when trying to come up with a relative valuation of the business. And last but not least, and where we spend probably most of our time, in the right situation, the right time, we help those clients sell that asset. So that's our service offering in a nutshell. And there's a lot of gray area in between, those three service offerings and what we do and how we make ourselves available to Baird's private wealth clients.
So Jason, you spent 8 years in the NFL, which is pretty cool. And actually what's really cool is one of those years was on a Super Bowl team of my favorite team, the Green Bay Packers. Go Pack. Tell us, from that experience in the NFL, is there anything that allows you to bring to the table for business owner clients that might be unique?
Well, first, it's good work if you can find it. So I enjoyed my experience, but like everyone, it ends at some point. And if I have to pinpoint one thing that makes a team or a professional successful, probably has to do with the amount of preparation you put in something. You know, everyone sees Sundays and whether you win or lose, but it doesn't just happen on Sundays. There's a whole week of preparation before that, and then prior to a season, I mean, you're doing a full off season of 6 months of workouts, OTAs, mini camps, training camp. So there's a lot that goes into those 17 games a year. And people forget about the importance of the preparation. So if anything kind of correlates between success in the NFL and success in investment banking or in a transaction, it's making sure you go through the prep work. That is where most of the time is spent. And if you try to skip a step and jump right into a process for one reason or another, you don't de-risk your process and you don't really have an optimal outcome by skipping the preparation. So that's where we spend most of our time to ensure that objectives are aligned. We dictate the behavior of our buyer pool and ultimately, maximize the opportunity to sell the business, because most business owners get one shot at it. So you want to make sure you do it right.
And that's awesome, and that totally fits into what we're going to be talking about. And coming up next, we'll be talking about transition considerations. So, Jason, when talking to business owners about a transition, what are some of the most common concerns that they express to you?
When's the right time to get started to begin with? Half of businesses transact involuntarily. Death, divorce, on the lower end of the market. Shareholder disagreement, disease, and the rarest of the Ds is disinterest. So understanding when's the appropriate time, knowing that most business owners and managers of companies are consumed by the day-to-day responsibilities of actually operating the business, don't really put much thought into the potential or the inevitable transition out. So it is never too early to start the transition planning process. So the when do you start is now. There are a number of steps, and there's a certain amount of time that takes to be successful in transitioning your business. So it is never too soon, and you want to avoid the situations where it becomes too late. And there's a number of issues you need to consider when starting. It's most important to identify your objectives. How much longer do you want to work? How involved in the business are you going to be? Who's the right partner? So all of these things kind of have to go into play. And if you don't have a plan in place or you haven't started the process, at least start having the right discussions with the right people so you can get the ball rolling. So if the inevitable happens or the right situation pops up, you want to make sure you're at least partially, if not fully prepared, to be able to act at the right time. Second and biggest concern, everyone's concerned about money. How much is my business worth? It is hard for a business owner, and especially in that sub $100 million market. You have a rough idea, but more often than not, they make unlike comparisons. Their buddy sold a software business at the country club, and he's talking about he got 15 times or 5 times his ARR. Well, if you manufacture widgets and you're doing 2 million in EBITDA, you're not getting 15 times or a multiple revenue. You're getting a multiple EBITDA. So that's really where we spend a lot of time. Is level setting expectations, providing data to clients to ensure they know in a range where their business is going to be valued at any given point in the marketplace. And then, that impacts their overall financial picture, their plan, their personal balance sheet. Considerations come into play as, is it all cash at close? Is some of it deferred? What's the tax implications? So that's a big concern for business owners. And there are a number of nuances that you have to address on the front end, during and after the process to ensure you kind of maximize the liquidity event. And I think outside of dollars and cents, the next largest concern is, will this buyer of my business be a good steward of the business? If you run the right process, you run a tight process, valuation, at least for a couple of buyers, are going to be in a pretty tight range. So from there, it becomes it goes beyond the quantitative analysis, it goes to qualitative. Is our cultures aligned? Are they going to take care of my employees the same way that I took care of them? And for those who have their name on the building or they're the brand, what happens to the name? Does it get consolidated up to corporate, or are they going to preserve the legacy of the business going forward? So those are probably the three most common questions or concerns we get on the front end.
Yeah, super important. When you think about timing of a transaction, is there really a best time for a transaction to take place?
I'm going to put the same question back to you. Is there a best time to time the market? Probably not. And if anyone could do it, probably lying about it, or they're lucky. But I prefer to be good than lucky. So I think ultimately, when it comes to determining the best time to sell your business, four things have to line up. First, the markets have to be performing well. The last few years have been problematic. That's a function of the macro perspective, interest rates, inflation, private equity and strategics kind of holding back from a transaction perspective, all probably root cause from the 2021 M&A markets. Money was flowing freely, interest rates were near zero, valuations were at peak. So money got a little bit more expensive. And then owners' expectations from a value perspective didn't correct to what buyers were willing to pay in like 22 and 23. So you just saw deal volume drop off. Interest rates have stabilized. I think the long-term macro picture has stabilized, pending what happens in Washington at the end of the year. And then activity has picked up, I think, tremendously this first quarter of the year. So I'm very optimistic about the 2024 marketplace. I think we'll talk about that a little bit later. So box one, check. Market's performing well. Two, and it's only something the business owner can answer, is the business performing well? When we go to market to sell a company, we're going to have a very thorough marketing deck. And in that deck, we're going to have projections, for sure through the remainder of the year, the next year, and probably a 5-year forecast. And it's better to have a trend going up than going down, margins expanding, not contracting. So if the business is performing well and what appears to be the brightest days are ahead of you, you can check that box. Third, and where your team and our financial advisors come in, is it enough money? Headline numbers cute. How's that structured? How much is that a rollover? But the most important number is how much is left after taxes and fees. And then what does that look like from a diversified income producing portfolio to fund me to and through retirement? And fourth consideration is, are you prepared for what comes next? That's all encompassing of your transition from an owner to an employee. Most owners make pretty bad employees. But your willingness to give up control is directly correlated to the size of the check you're going to receive. And then after you're all said and done, you can actually retire or walk away from the business. What's the plan for afterwards? Like football players, business owners have spent the majority of their life building this business, identifying as this business owner. And then for the first time, they're staring into the great wide open and don't know what to do. So they have to find some sort of competitive outlet that allows them to expend the energy that they once spent on their business, now needs to go towards other avenues. Otherwise, if you can't figure out four, you're going to have regardless of how much money you make, pretty unsuccessful retirement.
Yeah, it's so true. So when people come to us and they're asking us these questions, they're laser focused on business performance and how the business is doing. They're asking us questions about what we see in the market. Is it enough? What comes next? And that's kind of what we talk to them about. I want to say you mentioned inflation, so I just want to mention some thoughts on that a little bit. Inflation does impact valuations, and we see this in the public markets. So we're showing various multiples for the S&P 500 versus inflation ranges. And when we saw, when inflation was trading, kind of in that 2 to 4% range, or 0 to 2%, we saw multiples in the 17x type area. When in June of 22, inflation hit 9%, and so multiples dropped in the public markets considerably. We saw a 20% plus correction in the S&P 500, and a lot of individual issues dropped even more than that. That's a 30% change in terms of multiples on that inflation range. Now, I'm not sure if you saw that, a lot of multiple contraction in the private space. I'd be curious to know your thoughts, but we know there were considerably fewer transactions, but was there really multiple contraction that happened in the private space?
I think we're going to talk about this later on in our discussion, but the great part of being in the lower middle market, we are not as tethered to interest rates as middle market and the upper market investment bankers have to deal with. We're not trading at the same multiples as publicly traded companies. I mean, there is an impact on the number of deals getting done, but fortunately, on the sub $100 million enterprise value range and underneath, multiples haven't fluctuated that much. Now, it depends on the business, and ultimately, there's some bias because the deals got done were of top tier quality. And those medium to lower quartile type businesses just didn't transact. So that's probably skewed a little bit from a multiple perspective. But on the whole, probably over the last 10 years, multiples in the lower middle market from a private equity transaction standpoint have not fluctuated dramatically on a year to year and cycle by cycle basis.
It probably goes more to like how the actual business owner is able to perform through that environment. Is that what you would think?
And the relative size of these transactions, you can typically over equitize the deal and then maybe restructure down the road. So you can put a little more cash up front to get the deal closed because ultimately it's accretive to the overall and larger platform.
Yeah, because I mean, we've gone through that first wave of inflation where we went from the 2% all the way up to the 9% and then back down. We're right around 3% in terms of inflation now. We fully expect though, coming really out of the next couple of years where we'll start to see inflation go back up. So we'll get at least we expect to see a second wave of inflation, and historically that's what we think happens. So we'll have to pay attention to that. But the how much do we need question is something that we get on a regular basis, and it's important to think about that, because if you start on that and you can come up with a range of different values based off of different assumptions. And so what we're showing you here is kind of a graph of that. This is an example of somebody that came to us and said, hey, I think I'm going to get about $25 million after tax. What does that look like for me? And that sounds like a lot of money, but in this particular case, this individual had a fairly healthy spend of about $1 million. And when we model that out, in an uncertain world, using some Monte Carlo analysis, what we're concerned about is that zero line. And because there's a long horizon here, about 30 years, that arrow right there is what we refer to as a bust, and that's a bad thing. So in this particular situation, there was about a 50% chance of success. And so our advice to this particular individual is like, well, you really don't want to do a transaction now. You really, in order to get up to about 80%, unless you can make some changes, you really want to get, somewhere, grow the value of the business to where you can get, about $29.5 million, $30 million, or be able to reduce your spending by $150,000 a year. Neither of those would be reasonable outcomes. I mean, really what we're looking for when we see the planning is we want to see, this sort of situation in front of you right now where that zero line never gets impacted. You start with a range and you kind of go up to very significant levels. And so this is a situation where over time, once you sell the business, you're going to have wealth that outlives you. So when you have wealth that's going to outlive you, really, there's only 4 places you can go with that money. You can pay more taxes, which very few of our clients want to do. You can give the money to your heirs. You can make charitable contributions. And one thing that is always something to think about here is when you have a transition event, like a sale of a business, you want to make sure you're maximizing that charitable deduction in that year, because that's when it's going to be most valuable to you. Or, from a planning perspective, and that goes back to what do you want to do next? You can spend more during your lifetime. I mean, so we shared this with a client out in Washington, D.C., and his response was, geez, now I've only got so much time left. I'm going to start flying private. And that was a really good use of his wealth and way to spend. I mean, we've got a couple things coming up, and I don't know if your clients are talking about this, Jason, but I'd be curious to know. But in 2025, or at the end of 25, the Tax Cut and Jobs Act of 2017 is going to sunset. And so when that sunsets, you're going to have the QBI, which is qualified business income, go away. I mean, assuming that nothing is done differently about this, you're going to have AMT come back. You're going to have the highest tax bracket go back up to where it was by, I think it's a couple percentage points. The estate tax laws are going to change. And so is that, are you having discussions around that, or is that going to affect the market in any way? Should those things kind of, or is that just something that, we don't know what's going to happen, so we really can't think about it right now?
And if I knew what was going to happen in 2025 and beyond, I probably wouldn't be on this call right now. Where else do I have to be? No, I think it is something, especially for those who are considering a transaction, out 2-3 years. I mean, we get introduced at any stage of the process. We've just started the business, we're 20 years in, we're 10 years out, or I wanted to sell it yesterday. Depending on where you're at in that spectrum, they care less and less what happens in the future. But the last thing you want to do is ride out another cycle, especially if the business is performing well. They've seen too many cycles. They're tired. The burden of business ownership and the administrative headaches that come along with it just eventually just become too much. By some of our clients, get the right phone call on the right day and say, now's the time. So it's not very thoughtful, but they've done enough planning, preparation to understand it's the right time from a market perspective, business perspective, from a financial liquidity perspective, and they're prepared to move on. So maybe not as thoughtful on taxes, although the state exempt or the estate exemptions are concerning for those clients that want to eventually give or gift shares or dollars to their kids. But it's more of an afterthought. Primary function is making sure the business performs well and they can maximize dollars and partnership at time of transaction.
Okay, so we're going to be talking next about the transition process that follows once you receive that phone call. So Jason, once a business owner has a sense of financially what they're going to need from a transition of their business, what are their options that they can pursue?
I think it all depends on that number, right? And when they need that number to hit. There are a number of options available to most business owners. You see, am I going to gift this to my family? Am I going to sell it to my family? Am I going to be bought out by a partner? Most of what we deal with is third-party sales. So we do have some family transition dynamics, some ESOPs, IPOs, liquidations are kind of, IPOs are more at the global investment banking level. Liquidations, we don't typically deal in distressed situations, but those are all, potential options because frankly, we have come across a few during our tenure where that's probably the best bet.
Is that third party? Is that private equity, or what is third party?
We think of third party sales as any outside party, whether it's strategic or that a pure play financial sponsor, private equity firm, or that gray area, the private equity sponsored strategic. So some mix of those, and depending on your view, they can be treated differently, the same. But that's where we spend most of our time. We do deal a little bit with the family dynamics and multi-generational business. And anytime we have that conversation on the front end about wanting to transfer or sell the business to the kids, I feel like ultimately the parents or the first generation or second, whatever the case may be, just wants to provide financial security. And that next generation, frankly, is only in the business because they feel that's the right thing to do and they just want the money. So there's a way to maximize the opportunity liquidity event for that first generation, set up that second generation, and then you can avoid all the headaches that come with the family dynamic of disparate levels of participation, disparate levels of ownership, competency. The last thing you want to do if you have this ideal in your head of transitioning the business down to the next generation is find out too late that they're not competent or capable or don't really care to run the business. So it's always our advice to do what's best for the family in total. But more often than not, that means finding the right external party to maximize liquidity now and still provide an opportunity for the next generation to flourish in what's going to ultimately be a larger corporation. And if they're going to succeed under your ownership, they're going to succeed under their ownership. So nothing's kind of given to them. And at the same time, you can, kind of support them by creating financial security through the sale of the business. So that's what we feel probably the avenue explored the most or ideal on the front end. And they realize, A, my kids can't pay me what I need to retire. B, they may or may not be capable. So ultimately, the best thing for them is for you to sell to somebody else. That's not always the case. But just for the situations that we have dealt with historically, that ultimately ends up being the best solution for the family. And then you can avoid all the headaches when G2, G3, G4 get involved. Because ultimately, someone's going to sell it. You don't get to take advantage of the premium valuation, or they're going to ruin the business. And then you're all in trouble. So that's one we have a lot of conversations around. But again, we spend most of our time helping business owners find the right strategic or financial partner so they can not only maximize the liquidity event, but optionality, cultural fit for the employees and the business on a go-forward basis.
So do you see, like, so we just had a situation recently where actually a client brought this to our attention. A friend of his owned a business, a very successful business in Ohio, a manufacturing company that, the partners no longer got along. And so they were going to need to sell this, but they had a really strange agreement where it was basically a 50-50 ownership. And there was no one that could decide, well, what should we do, or how, you buy me out, I'll buy you out. And it just became a mess. I mean, do you see that quite a bit, or is that something that's more unique?
In the rare instance that a split partnership, they're typically in agreement, but that's why you have a very well thought out, and this becomes more of a legal exercise, buy sell agreement. And then who ultimately makes the final decision if one partner wants out, one doesn't. And there's a number of options available to them. You can do a dividend recap. There's a number of debt-like or equity partners out there that will help you do or effectuate an MBO, management buyout, to get them out of the picture. So it all depends. But fortunately for us, most of the owners we deal with have a controlling interest in the business and dictate what happens. That being said, there are other stakeholders involved. It goes beyond just the owners and the managers, but more often than not, family members get involved in discussion, because what happens at our end of the process impacts the family.
Right. And so another thing we hear, some of you mentioned like employees there, because oftentimes we'll hear, well, I want to preserve the legacy. And, I think that the best way to do that is going to be to sell it to my employees. But I've seen that sometimes be problematic. I mean, what's been your experience with that? Can it work, or is it harder to do than expected?
Ultimately, it depends on the form of the sale to the employee. So this is a non-qualified plan, they're buying it. But when we have seen transactions that's 100% sale to an employee, financing can become an issue, and you're not going to get a premium valuation. We just worked with a deal in Wisconsin, on a deal where a very marketable business, it was in residential services, of size. It would garner a lot of attention from the private equity world. But they thought they were doing the right thing by selling it to a younger couple that worked inside of the business, and they knew it was going to come at a discount. But the issue that they are running into, or will potentially run into, is how are they going to finance it? Because it goes beyond the limits of an SBA loan. The private capital markets tend to get a little expensive. So ultimately, what may end up happening, because they do have to hit a certain number to kind of fund their retirement, they may have to go to a third party anyways.
Okay.
ESOPs is another one. We kind of have numerous conversations around ESOPs. I think in the right situation, it makes a ton of sense. There's tax advantages to it, until the owner, again, liquidity coming back in the picture, realizes that half to 2/3 of the financing is going to be a seller's note. You're going to have some bank financing, and they're going to be stuck, holding on to that note for the business the next 3 to 5 years. So it's a longer exit or transition period, but in the right circumstances, it makes sense. Our saying is, depending on your preference, ESOP's probably always an option. Again, assuming the business supports it. But that's only if you can't find an outside party. There are ways to take care of employees, provide compensation or some transaction bonus that makes them whole, or allows them to participate in the liquidity event that goes beyond the cost and the legal headache that comes with ESOP formation.
Yeah, I think it's probably, though, a good idea to think through the different options. But once you've done that, or you kind of got a path you go down, I mean, what does the timeline look like?
That's a great question. I think Most people are always surprised. This isn't like selling a house. You put it on the market, you get an offer and you hand over the keys, you walk away. I mean, businesses are living, breathing, beings more or less. And I always tell people you have to think about these in multi-year stages. So you determine, sometimes arbitrarily, this is the last day I want to spend in the office. Hypothetically, I'm 60. At 65, I no longer want to step foot in here or work. So you think, okay, well, who am I going to sell it to? Depending on if it's a strategic or a private equity pure play sponsor or private equity backed strategic, you're going to be expected to stick around at a minimum a year. I say that I've seen less, maximum 5 years. So that time horizon, okay, I got to start at 60, but wait, I'm already 60, and selling a business from start to finish, takes a tremendous amount of time, and we'll cover that in more detail next. And that's assuming the business is ready to sell. So factoring in all these years, all these moving pieces, the pre-process planning can take years. If you don't have the right team in place, you may need to make a strategic hire. If you're implementing an ERP, we've seen that go very poorly during a process. So you want to make sure you get through it, implemented, and running smoothly and seamlessly post-implementation. If you have customer concentration, it takes years to dilute your customer base. So these are all things you have to consider when going into the process. That's why I always say it's never too early, because unfortunately, some of these pre-planning processes or efficiencies or value drivers take years, and you either don't have the people or the willingness to kind of execute on it to get to where it could be to maximize value. Again, it gets to that point where the business owner's tired and they know it's going to take a couple of years to kind of write the business, but would just rather settle for what it's worth today than going through the headache and potentially having another misstep. So this is a multi-year process. And all that being said, when the business is ready to sell, you hire a banker, you go to market. At a minimum, you're looking at a 6 to 9 month period. If you want to go to that next slide, Andrew, we can talk about kind of the 4 phases of the process. I talked about preparation earlier. A good portion of our time and the owner or manager's time is spent in that pre-process planning. We pull in a lot of data. We use that data to put together a marketing piece, and then we go out and actually market the business. So, that pre-process planning, preparation, it's a month, month and a half, 2 months, depending on how much data you can get to us in a timely manner. And then from there, we take that information, we go out to a select group of buyers. They all get the same information at the same time, and it allows us to kind of dictate their behavior. So we can kind of maximize our optionality, we can drive competitive tension. And at the end of it, it ultimately, provides the potential highest liquidity event, and outside of liquidity, the potential best deal values. So from there, after that's all done, we've gone to market, we presented the information, then the fun time begins. You pick buyer selection. You ultimately funnel down from what could be a very large group, say 100 or so potential targets, down to 4 or 5 folks you have a more intimate conversation with. You share more data, they come on site, they meet you, they meet the management team, depending on the situation. And then from there, you pick the final buyer and you move into due diligence and then closing the transaction. And if it goes well, that's a 6 to 9 month process. So you have to factor process, the pre-process planning, and then ultimately, what your roles and responsibilities and time commitments look like on the back end of the sale.
Right. Most every single one of our clients have had a liquidity event or partial liquidity event of some kind before they came to us. And, so in preparation for this presentation, I went and talked to a bunch of them and asked them like, hey, what do you wish you would have known prior to the transaction? And almost to a T, I wish somebody would have, beat it into my head in terms of like what a heavy lift that this was going to be. Because I was blown away by what it actually involved. And so I think, it comes back to what you're talking about from a preparation standpoint, an early planning standpoint. And, when I think about the folks that have come to us after they hear ITR present and talk about, what their expectations are for the 2030s, and they want to get out, but they're going to wait until like, 27 or 28. I think that, from what you're saying, and you correct me if I'm wrong, but it sounds like you should be starting a lot earlier than that.
Yeah, yeah, it all depends on the situation, but again, it's never true, and it goes back to those, four considerations, right? And if that lines up, I think the Baron Rothschild once said, "I made a great fortune selling too early," um, because in our business, you never know if you sold too early, but with 100% certainty, you know if you acted too late. Business falls off, market falls off, and then you're now in a different situation and are forced to sell for one reason or another. Um, that's not optimal or desired by anybody. So
Right.
it is, and then to your point too, it's a very heavy lift. Deal fatigue is real. We try to be very transparent on the front end because never have we ever had a client come to us after the fact and say, "Hey, that was fun. Let's do it again."
Yeah.
There's
Yeah.
a lot of emotion, a lot of frustration. Um, it's very time consuming on top of what's already consuming from a running your business perspective. So it's like picking up a second job at a point in your life. You probably don't want a second job.
Right. Right.
But again, it goes to the preparation and maximizing the opportunity at hand. It's a necessary step. It's necessary work, unless you're just willing to give your business away.
Right. And everybody wants to maximize value. And so we'll be talking about some valuation drivers coming up next. So, Jason, besides the uncontrollable market forces that may come into play, what can a business owner actually control that will increase the value of their business on transition?
I mean, there's so many elements of a business that one can change, alter, improve. But I think the easiest and the one most often overlooked is the importance of building a team. Maybe another reference to my playing days, but I can't underestimate or overstate the importance of having the right team in place. And it's easy to do. It's just a matter of having the right conversations with the right people, because it's not just a business owner. Most owners are consumed with running their business, and that's enough of a pull for them. And none of them have the capacity, and most of them don't have the capability to run a thorough sell side process. So it requires a team of outside professionals, and that's an investment banker. You actually have someone who knows how to sell a business. There's going to be a liquidity event at the end of it, so you want to make sure that you're well represented from a financial advisor perspective, because sometimes this is a significant liquidity event for some folks. And if you don't have appropriate management there, I mean, the last thing you got to do is hit a home run selling a business and then poorly manage your money post transaction. And I think CPA is obviously important because headline numbers are great, but we want to know exactly what it's going to be when the dust settles and you've paid the taxes, you've paid the fees. And if I had to pick outside of investment bankers, the advisor that's worth their weight in gold is your attorney. Most lower middle market business owners have relationships with a cousin, their buddy that does real estate law. If they don't have appropriate M&A experience, you need appropriate counsel. The last thing you want to do is go into a transaction with your cousin who does real estate law, and you have Jones Day sitting across the table for buyer representation, and you get overwhelmed and bullied, and it's not fun for everyone. So, paying for appropriate counsel, they are worth their weight in gold.
So when thinking about putting the team together, when should a business owner do that?
Immediately. I mean, it should be in place now. And if you haven't done it now, start having the conversations. Find out, does my legal representation have M&A experience? They have experience in this space. When was the last time I did a transaction? Financial advisor, obviously, if they're working with someone at Bear, they're well represented. But having discussions and multiple discussions, because it's you may fit or connect with one person, but you do this once, you should have multiple parties kind of involved, because you never know. Each one has a little bit different flavor. But at the end of the day, you have to be able to trust them. You have to be certain that they have your best interest in mind. And then from a financial perspective, you got to make sure that they're out to get you the most money possible. And then once those three align, you kind of have the right team.
Many of the people viewing this presentation are likely Vistage members. And so one thing I should point out is that, talk to Vistage Share or other members in the group, I mean, there's people that have been through these before. A lot of Vistage Shares have seen transactions, have gone through them before, have contacts, people that, if you need a better attorney, a better CPA, I mean, of course, we can make those recommendations or suggestions, and Jason can as well. But your chair of your group is a good contact for that. So besides these things, besides having a good team, what else drives value? I'm sure there's a lot of things.
Yeah, great question. There's a long list, and there's it's a company by company basis. It's an industry by industry basis. But from a holistic picture, essentially when you're thinking about value drivers from a business characteristics perspective, you look at how large is the market that I operate in? How attractive is it from a cyclicality perspective? How unique is my offering, and how much of that total market can I capture? So that kind of gives you the opportunity that's in front of a particular business at any given time. Another thing that's really important is having the right team and processes and systems in place. If you want to really show well from a marketing perspective, having a built-out management team that is, you have the right people in the right positions, making the right decisions based on the right data. So without the right people, processes, and systems, you're going to have a little bit of a discount relative to a more professionalized and well-run businesses. And listen, on the smaller end of the spectrum, it's impossible to get all those pieces together. Otherwise, you'd be probably a larger business. But keeping that in mind, understanding when you talk to an investment banker, there's a range, kind of depending on where all these qualitative and quantitative aspects, kind of where you're at from that perspective, kind of determines where you fall in that range of value. So, addressable market, attractiveness, and having the right team in place. And then from beyond that, from a financial perspective, I think the highest correlation to the multiple paid for a business is all dependent upon growth. I mean, you see it in the public markets. It's certainly true in the private markets. The faster you've grown and the more believable your future growth is, the higher the multiple you're going to get for the business. And then, you can look at it from a margin perspective. All your margin metrics or your performance metrics are all based on a comparative basis to your competitors. So each industry has their own standards. There's too many to kind of go through. But if you talk to the appropriate, investment banking group, they should be able to tell you pretty quickly exactly where you need to be relative to your competition to attract the most eyes and capture the highest value on a transaction.
I've talked to a number of owners and they'll tell me, hey, I want to go to market, or I want to, sell my business, but I want to capture these various growth opportunities first. I mean, so what would you say to somebody like that? Do you try to get it all, or do you leave some on the table for the next guy, or what's the best approach to that?
Well, if you get it all, there's nothing left for the next guy. And you always have to, there's that blue sky you have to tease out, and in every process, there's two sides. There's the narrative and the numbers. First and foremost, you have to execute on a growth strategy. You have to have a proven track record. And this is something that is critical in the process. Again, when we go out to market, you have to execute on the growth strategy. You have to hit your numbers, or it brings skepticism, and you lose credibility throughout the process. So I think to an extent, you're not going to get paid on performance in 5 years. But again, going back to how long it takes to sell a business, let's say we're marketing a business now, and we have a full 2024 year projection. Our expectation is to be paid on that number based relative to a TTM number, because by the time the process is over with, we will know if we've hit that number or not.
Right.
So everything's kind of based on a multiple of your trailing 12 months EBITDA, but that shifts from the start of the process to the end of the process, and you better hope you're trending towards that projection. Otherwise, valuation comes back into play.
So that's kind of your proprietary checklist. Is that something that we'll be able to make available to people that are viewing this along with the rest of the slides?
Absolutely.
Okay, great, good. Okay, so we've got the transaction done. Then post sale, and we'll talk about that next.
Chris, from your perspective, what should an owner think about as it relates to post sale?
It's really interesting because we'll oftentimes see people. We'd like to see people earlier in the transaction because we can help with a lot of planning. But sometimes people have a transaction and they kind of just show up at our door. What do I do now? But research tells us that people have about 180. I think it's more than that. 80 biases, cognitive biases, and these are things that really are ways that the brain simplifies how it thinks about the world. It's like a framework for kind of thinking through. Four that we see all the time that are really great strengths as an entrepreneur, but tend to be weaknesses as an investor. It's actually, I always say it's what makes entrepreneurs great as business owners and kind of, have problems as an investor. Those are optimism, overconfidence, illusion of control, and anchoring. I'll focus on illusion of control and anchoring because those are the biggest ones. I mean, so when you have a business, you can kind of control everything. You feel like you can, move different levers in terms of like if you got a bad economy or a bad market, you can take charge of that and improve the situation. You don't have that in the when you go to a financial portfolio, and so it really does weigh on people from that standpoint. The anchoring side of things is that you really it's why we do the cycle work that we do, quite frankly, because when you're at the top of the cycle, everybody's feeling good about things, and but that's what people believe that's going to continue on. But right at the top is always when the downside is going to come, and so that's why I've always appreciated the work ITR and Brian Bolio have done, and why we use them as an input, because we try to get rid of that that point of it. The biggest thing that I think that business owners have trouble with is that they don't come to work and see a value on their business every day or a value on their real estate, and suddenly they've got a financial portfolio that really requires a different mindset, because they're getting a view of that on a minute by minute basis if they want. And so when you've got the business driving everything, you've got to think about you get your salary, your distributions, you got a tax rate, very illiquid, lots of control, and it's hardly ever valued. On a financial portfolio, it can be diversified, it can be risk managed. The beauty of it often is you can have a lower tax rate, it's very liquid, but you've got little control, and you're going to see valuation all the time. Those are the big things that we think that folks need to think about. Okay, so Jason, we touched a little bit on that current M&A market, but you'd like to get some additional thoughts from you on that.
Yeah, I think, as you mentioned, we discussed this earlier. You're coming off of a 2023 market. Your second consecutive year of declining deal volumes. As I mentioned, there's for a number of reasons. Interest rates went up, cost of capital goes up, and there's this disconnect between what buyers could pay from a financing perspective and what sellers are willing to sell at from an expectation perspective. There was limited PE activity last year, but there's record dry powder that needs to be put to work. I think S&P balance sheet cash levels are at a record high. So everything that we've seen, and from a public market perspective, the market's been performing well. So everything that we see kind of checks the box that 2024 and beyond should be a good year. Again, depending on what happens with the election. And unfortunately for our clients in this lower middle market, the middle market's 500 and below, but ours is really at 150 and below. Valuation multiples have not fluctuated that much. So business owners are always concerned about missing the crests from a valuation perspective. But for the most part, the average business valuation from a multiple perspective hasn't changed. It more has to do with how your business has performed through these cycles and how it's going to perform in the near future. And as long as you're comfortable and confident in the business performance, it could at any given time potentially be the right time to make a move.
Right. And as I said, we pay a lot of attention to the market cycle. One of the things that so we go through this kind of optimism as a baseline. Capitulation is at the bottom. People often say, well, what's capitulation? And that's really when you it's kind of the forced selling, or if you're in a burning building, you have to get out. I was joking recently with a new client. We're sitting, just sold the business, the money's sitting in cash. This was back in 22 when we had the 20% correction in the market. He wasn't even invested yet. And he calls me up, he goes, Chris, I think I'm capitulating. I just started laughing. because that's the time when we want to be buying in the cycle. When you get to euphoria, that's the time we want to be lightening up on risk. Where are we now? We really started the year really, after being at that fear level, we started the year at a place of optimism, and we're rising up above that curve right now. So we're going to have our new quarterly update out in really probably by the 15th of April. And so anybody on this that's viewing this that would like to copy this, just please feel free to reach out. We'll tell you where that's at. But we're probably past the excitement and thrill area. From a valuation perspective, we're going to probably see, given all the cash that's out there, probably a move towards euphoric levels again in the next quarter. And so that's kind of where we're seeing things right now. So yeah, we agree that cash is driving everything. So let's wrap up with some concluding thoughts and next steps. Okay, Jason, thanks for being with us today. We've got some final thoughts that we'll share with everyone, and really, it's pretty straightforward. I mean, so you got to know what you want out of transition. This will determine the path that you go on. I mean, you transition, options. Given your path, you have to think those through. Work with a team and use your team to think those through with you, and to have a thoughtful transition plan. I can't stress enough for the business people on the call to talk to your chair. I mean, being going through transition can be a really lonely a lonely thing, and so the more people you have that you can talk to confidentially, the better off that you'll be. Understand the drivers of value for your business. That's different for everybody. I mean, each different industry can have different drivers of growth. Be aware of the cycle and the time that you're going to need for your transition as part of that. Jason, anything from you? Any last thoughts?
Yeah, I just want to say this is inherently a complicated and emotional decision, and ultimately, helps the phone call away. What I love about our group is that I truly believe we help people. This is important work that changes people's lives, and ultimately, we're here to be a resource for you, understand what it is you want to accomplish, and we try to find a way to help you do that.
Yeah, and I would say whether somebody watching this, a business owner that's thinking about transition, whether you have advisors in place already or not, I mean, feel free to reach out to us, to Jason or to myself. Happy to provide you, some thoughts, whatever we see, regardless of whether you choose to engage us. I mean, I spend a lot of time, really love the educational process that we help people through. Jason, as I said from the beginning, rely on him a lot to get thoughts on what's happening, on the M&A landscape from any particular business. So feel free to reach out to them and just give us a call, send an email. Happy to chat with you. Thank you for joining us.